Hello students, welcome to Global Online Platform. The students who are preparing for the NTA UGC NET June 2024 exam from Management or Commerce subject, today's session is going to be very much helpful for you. In this session, we are going to do one short revision of Accounting and Finance unit through most expected MCQs. This session is going to be very much helpful from your exam point of view. After attending all these MCQs, you will be able to solve the questions from this Accounting and Finance portion in your exam very correctly. Before starting with the questions, there is an important information for you that the NTA UGC NET June 2024 exam is very close now. Our complete courses are on Commerce and Management are available to boost up your preparation. The new batch has been just started today, so you can join the batch. So if you take the course, you will get daily live lectures, complete syllabus notes will be provided, then complete syllabus mock test which has utmost importance at this time. 4,000 plus MCQs will be provided to you, PYQs with explanation will be provided to you, and the biggest advantage is if you take the paper 2 course, you will get paper 1 totally free. The fees is just 10,000, but after a discount of 20% you can get both the papers of 8,000 with a validity of 1 year, in which you can cover your both June and December attempt. First of all, download the Global Online app from the Google Play Store, then click on the store button in the home interface, then type UGC NET Management in the search tab, click the course, then make the payment, and after making the payment we will be able to access all the content of paper 2 and paper 1. If you face any sort of difficulty, you can contact on the given number mentioned below. Let's move to the questions. Which of the following is an example of consistency principle? Using the same depreciation method each year, then recording the transactions at historical cost, then preparation of financial statements at regular intervals, and recognizing the revenue when it is earned. So recognizing the revenue when it is earned, this is revenue recognition principle, not the consistency. Then recording transaction at historical cost, this is historical cost principle. This C will also be there, will not be there. Why? Because we are getting the answer, that is that using same depreciation each other. If you are using a fixed depreciation method, so you can use that. Then if you are using reducing balance method, so you can use that, but you are using same method every year. So this is the consistency principle. Option number A will be the right answer. Which accounting principle will be most directly challenged when a company switches from the LIFO, last in first out inventory method, to the first in first out without justification and adequate disclosure in its financial statements? Going concern principle, then consistency principle, prudence principle, and matching principle. So first of all, see what this question is again related to accounting principles and concepts. This is a very important topic from your exam point of view. So I am taking the questions. So LIFO and FIFO are the inventory management techniques. So if a company is shifting from LIFO to FIFO, at that time going concern, this is related to purchase subsection, this will not be hampered. The prudence, which is pre-estimation of losses, matching will not be also get hampered. The principle which will be get challenged is the option number B, consistency principle. Option number B, consistency principle, will be the right answer. Let's move to the next question. Statement 1, the accounting convention conservatism states about the anticipation of both losses and gain, and statement 2 states that the accounting to the concept of going concern, expenses of both the firms and owner are recorded separately. Both statements 1 and 2 are correct, both statement 1 and 2 are incorrect, then statement 1 and incorrect, but statement 2 is correct, but statement 2 is incorrect, but statement 1 is correct. So here you have to answer from the options given below. It is asking about the convention conservatism. Conservatism is what? Here you anticipate losses, but what is mentioned in the statement? Losses and gain. Gain is nothing but the profit. So this statement will get incorrect. Now let's see statement 2. According to the concept of going concern, where expenses of both the firms of and the owner are recorded separately. This definition is concerned with the separate entity concept. Separate entity concept but here means the word mentioned is what? The word mentioned is going concern. Going concern states that the firm will have a life even after the death of its owner. Okay, so going for have a life of perpetual this is also called as perpetual succession. So this statement will also be incorrect. So obviously your right answer will be option number B, that the both statement 1 and 2 are incorrect. Which among the following is an approach to the capital structure decision and is relevant to the valuation of firm with usage of debt up to a certain limit? Option A, net income approach. Option B, net operating income approach. Option C, traditional approach. And option D, Miller and Modigliani approach. So basically it is talking about the capital structure approaches are classified into relevant and irrelevant approaches. The net income and net income and traditional are relevant, and net operating income and Modigliani Miller are irrelevant. Okay, remember this can be asked in statement based question. Now let's come back to this question, what it is asking it. Then which among the following out to the capital structure is relevant? Okay, worst, so you can easily delete this too. Okay, then usage of debt up to a certain limit. Usage of debt up to a certain limit. So this has been said in the traditional approach given by Ezra Solomon. The traditional approach which is given by Ezra Solomon, he stated that a company should use debt in up to a certain limit only because after a particular point the cost of equity starts rising if the company exceeds the usage of debt. Okay, so option number C, traditional approach, is the right answer. Next question, when dash is 0, the decisions are considered on the basis of other factors considered to take the appropriate decision. Internal rate of return, profitability index, net present value, all of the above. So basically here some capital betting techniques are mentioned, and if the question is asking that if answer of dash becomes 0, other factors are considered to find out to take an appropriate decision or long term decision related to capital budgeting. So it's obviously right, if IRR gets 0, you will consider other factors. If profitability index gets 0, you will consider another factor. If NPV gets 0, you will consider another factor. So all of the above is the right answer. Next, move to next question. Which among the following is the most expensive long-term source of finance? Debentures, bank overdraft, equity share and preference share. First of all, you should delete the bank overdraft. Why? Because bank overdraft is not long term, it's short term. And what the question is asking? It's asking long term. Now, debenture is the cheapest sources of finance. Why? Because tax is not charged on debenture. Okay. So basically equity shares are the most expensive source of finance. Why? Because the cost of equity is very high and equity share involves higher risk as compared to preference share. In case of equity shares, dividends are not given consistently, but in case of preference share, dividends are given consistently at a certain pre-decided rate. So option number C, equity share, is the right answer. Let's move to next question. Which model of dividend decisions has the term retention ratio? Walter model, share valuation model, dividend capitalization model, and all of the above. Now let's see, whenever a company earns profit, some of its amount of the profit is distributed to the shareholder, both equity and preferences. Okay, so that term, the amount which is distributed is termed as dividend. Now dividend decision it is asking about, and it has said which model of dividend consists of retention ratio. The retention ratio is determined by G is equal to BR. You can remember like Gabbar. Okay, now dividend Walter model doesn't consider the retention ratio. Share valuation model is another name for the Walter model. So same, this will not be the answer. All of the above will not be the answer. The right answer is option number C, dividend capitalization model. Dividend capitalization model is nothing but the Gordon model given by Meron J. Gordon. This is also known as the bird in hand theory, that Meron J. Gordon has also given the bird in hand theory. So according to this question, the term retention ratio is option number C, dividend capitalization model is the right answer. Let's see the next question. Dividend policy decisions involve determining how much retained earnings to reinvest and how much payout as a dividend. How much debt to issue, and option number D, both A and B. So I hope you may be feeling this question, but don't make hurry. Take proper decisions while selecting the answer. So dividend policy decision determines what? Suppose a company has earned profits of 1 lakh. It has both the options. Either it can retain all the 1 lakh profit, or it can distribute among its shareholders. So the retained earnings, whatever the earnings which are retained by the company, it may decide to reinvest under the dividend decisions, or under the dividend decisions it can decide in what proportion or in what amount they should pay out the dividend. So option number A, both A and B will be the right answer. This C option will not be there because it is not concerned, there is no concern of issuing of debt. Let's move to next question. A high degree of operating leverage indicates that the company has a fixed cost relative to variable cost. The company has low fixed cost relative to variable cost. The company has a high level of debt, and the company has low level of debt. Now let's listen to me first thing. There are three types of leverage: operating leverage, combined leverage, and financial leverage. Now it is talking about the operating leverage. There are two types of cost observed in the leverage chapter. One is the fixed cost and another is the fixed financial cost. Okay, these are the two types of cost which are available, which are observed in the leverage chapter. So basically, the company who is using high fixed cost, we can say that the operating leverage of the company is high. If the company is using debt at a large proportion, then we say that the financial leverage of the company is very high. And either it is operating or combined or financial leverage. Leverage is always determined in the units of times. Okay, so option number A, a company has high fixed cost relative to low variable cost, is correct if a company having high degree of operating leverage. Okay, let's move to next question. RAM Limited, a chemical based business company which does not have adequate working capital, it fails to meet its current obligations, which leads to bankruptcy. Identify the types of decision involved to prevent the risk of bankruptcy. So, investment decision, dividend decision, liquidity decision, finance decision. So basically, RAM Limited is what? It's a chemical based business company, chemical based business company, and he is not able to arrange sufficient working capital. Working capital means what? The capital which is used for day-to-day expenses, and he is not able to fulfill the current obligation, and he has reached a certain situation where there is a chance of bankruptcy. So how it can prevent the dividend bankruptcy? So let's take one by one. By investing, whether he will be able to prevent? No. By dividend? No. By financing? No, because the bankruptcy situation arises when a person is not able to repay the loan. So option number C, liquidity decision, means he will close or he can close or sell out the business to get the sufficient fund and fulfill the repayment of the loan. Okay, option number C, liquidity decision, is the right answer. Next, see how are earning per share calculated. Okay, now let's go through the option first. Use the income statement to determine the earnings after tax, net income, and decide by previous periods earning after taxes. Then subtract 1 from the previously calculated value. Then use the income statement to determine the earning after taxes, net income, and divide the number of common shares outstanding. Then use the income statement to determine the earning after taxes, net income, and divide by the number of common stock and preference stock outstanding, and use the income statement to determine the earning after taxes net income and divide the forecasted periods earnings after taxes, then subtract 1 from by previously calculated value. So obviously it is talking about what? It is talking about the EPS. EPS means earning per share. Now in a case of EPS, 1 is not either added or subtracted. So wherever it has said that subtracting 1, the both options are totally incorrect. Now you may get confused in option B and C. Now let's see the question. Option B. So basically income statement to determine the earnings after taxes net income and divide the number of common shares outstanding. But here same thing is written, but the additional is what? Additional is preference shares outstanding. So while computation of the EPS, only common shares outstanding is considered, not the preference. So option number B, use of income statement to determine the earning after taxes net income and divided by the number of common shares outstanding is the right answer. In general case, if you see EPS, there is a long way to reach the EPS. First of all, we have given sale, then we reduce the variable cost, then we get the contribution. After contribution, we can we reduce the fixed cost, then we get the EBIT. Till here the operating leverage works. Okay, now after EBIT, from EBIT we reduce the interest, then we get the EBT, earning before taxes, then we reduce the taxes, we get the earning after taxes, then we out of this then we reduce the preference dividend and we get earning available for there is some error. At last we get earning available for equity shareholders, then we divide it by number of shareholders and we get the EPS. Okay. Now next question, let's see. Statement we have given with the two statements. A company's financial structure uses long term and short term funds, and here value of the firm is considered. And statement 2, traditional theory considers the retained earnings should be used first in financing. Let's see. Company's financial structure uses long term and short term funds. Okay, a company's financial structure has may use long term sources and short term sources both, but a company structure it has no relation with the value of firm. Means it is talking from the perspective of capital structure theory, and here value of firm is considered, but the statement got incorrect. Let's understand why it got incorrect, because here it should be capital structure. A capital structure uses okay sorry, I was having water. The traditional theory considers the retained earning and should be used in the first in financing. But this statement is also wrong, because in case of traditional theory, there should be pecking order theory. So option number C, both statements are incorrect, is the right answer. Let's see the next question. All theories are considered absence of perfect capital market except dash. Net income approach, net operating income approach, traditional theory, and MM approach or MM theory. So first of all, absence of perfect capital market. Absence of perfect capital means what? In case of net, in the assumptions of net income approach, perfect capital market does not exist. In assumptions of net operating income approach, perfect capital market does not exist. In case of the traditional approach by Ezra Solomon, net perfect capital market does not exist. It only exists in case of Modigliani and Miller theory, where he said that perfect capital market exists, but it is a totally myth. So option number D, MM theory, is the right answer. MM theory has given two major prospects. The one is the aspects, one is the arbitrage, and another is the behavioral justification. Let's see which of the following is not cash outflow of the firm: depreciation, dividend, interest payments, and taxes. So obviously dividends are your cash outflows. Then you are making the payment on interest on you are making the payment of interest either on loan or on debt, so this is also an outflow, so this will not be there. You are paying taxes to the government, this is also not an outflow. The outflow will be option number A, depreciation. Okay, now let's see the next question. Which among the following statement is correct? Capital budgeting is influenced by short-term decision. Capital mix considers short-term sources of finance. Working capital can be permanent and temporary only, and dividends are paid by adding taxes in it. And according to Walter, decline firm prefer the dividend payout instead of retention. So you are given with the codes E, C and A, B and D, only E and only C. Now let's see. Capital budgeting decision, it is concerned with the long term, and what it is mentioned, short term decision. So one is totally incorrect. Now wherever A is mentioned, you can easily delete it. Option number A will be out. Then capital mix considers the short term sources of finance. No, capital mix or capital structure considers long term also, long term decisions. So you can delete this. Option number 2, B and D is mentioned. Then working capital can be permanent or temporary only. अरे भाई net gross भी तो होता है. Net and gross working capital also exists. It has written only, so this statement also get incorrect. So only C will be incorrect. So your right answer will be option number only E. Now let's check D. Dividend are paid by adding taxes in it. अरे भाई before paying the taxes, you reduce the tax. Before paying the dividend, you reduce the taxes. Okay, not add the taxes and then pay the dividend. This is not followed. First you have to reduce the taxes before making the payment of any dividend. Okay, now last statement check. According to Walter, decline firm prefers dividend payout instead of retention. So this is the Walter has given 3 conditions. R is equal to K, R is greater than K, R is less than K. So when the this is the normal form, this is the decline, this is the growth form, and this is the decline form. So when return is low and cost of capital is high, or the internal rate of return whenever it is high, the company will retain its profit or retain the amount which it has to pay for the dividend. But in case of decline firm, dividend are payout by the firm to attract the future shareholders. So option number E will be the right answer. Next question. All types of dividend are paid in India except dash. Stock dividend, where dividend is paid in form of cash, then in form of stocks, then or shares, then by issuing additional shares. Then cash dividend, you all know it is paid in cash or in form of cash. And property dividend, property dividend is a type of dividend which is not practiced in India. Option number A, property dividend, is the right answer. Next, see the question, statement based question. In case of decline firm, the rate of return is greater than the cost of capital. Dividend are distributed in this case. And in case of growth firm, the internal rate of return is greater than the cost of capital. All 100% payout is mostly preferred. Both statements are correct. Both statements are incorrect. Statement 1 is correct and statement 2 is incorrect, and statement 2 is incorrect but statement 1 is correct. Now let's see. In case of decline firm, R is greater than K. भाई गलत हो गया ना. R is less than K in case of decline firm. So this statement got incorrect. First one will be totally wrong. First one will be totally wrong. Now let's see the second question. In case of growth firm, second statement. In case of growth firm, the internal rate of return is greater than K. But here entire 100% retention is done, not 100% dividend is paid out. Okay, so obviously both the statement will get incorrect. Statement number, both statements are incorrect is the right answer. Now let's see. अगर डिक्लाइन फर्म है तो ऑब्वियस सी बात है कि भाई रिटर्न कम रहेगा, इंटरनल रेट ऑफ रिटर्न कम रहेगा और कॉस्ट ऑफ कैपिटल ज्यादा रहेगा. बट वहां पे कंपनी क्या करेगी, कंपनी पैसा अपने पास रख लेगी, कंपनी पैसा देगी नहीं, वो अपने फ्यूचर ग्रोथ में पैसा लगा देगी। बट अगर कंपनी अगर ग्रोथ फॉर्म है, उल्टा बोलती, अगर डिक्लाइन फॉर्म है तो रेट ऑफ रिटर्न कम रहेगा और कॉस्ट ऑफ कैपिटल जो है वो ज्यादा रहेगा। तो ऐसे केस में कंपनी क्या करेगी, फ्यूचर शेयर्स अट्रैक्ट करने के लिए वो क्या करेगी, डिविडेंड देगी, ताकि भाई बाकी लोगों को लगे कि यहाँ तो डिविडेंड दिया जाता है, देन व्हाई नॉट वी शुड कम एंड इन्वेस्ट अवर मनी इन दिस कंपनी। सो दे विल टू अट्रैक्ट द फ्यूचर शेयर होल्डर्स, दे विल पे आउट द डिविडेंड। बट in case of growth firm, the IRR is greater. Okay, growth firm in case of IRR is greater than K. Here return is high, so company is doing what? It is not paying out the dividend. It is retaining the amount which it has to use for paying the dividend. Okay, retention is followed under the growth firm and payout is followed under the decline firm. Let's see, a capital investment is one that has a prospect of long term benefits, has a prospect of short term benefits. It's only undertaken by large corporation, applies only to investment in fixed assets. So let's see which one is a capital investment is what? It's a prospect which having a long term benefits. Okay, so these three options will be total. Statement 1, the value of the firm can be determined by dividing the earning before interest and taxes by overall cost of capital. Okay, VOF means value of firm can be determined by the formula earning before interest and taxes divided by overall cost of capital. So same thing is said in this statement, so this statement is totally correct. Let's see statement 2, both the theories of capital structure given by the David Durand are not relevant in nature. First of all, try to understand the capital structure theories are classified into relevant theories as well as irrelevant theories. The irrelevant theories of the capital structure are net operating income approach as well as Modigliani-Miller approach. Then the relevant theories are basically the net income approach and traditional approach. Okay, so basically if you see that what he has said, David Durand has given two theories. One is the net operating income, which is the irrelevant, and net income which is relevant, and what he has said, not relevant in nature. Both theories given by David Durand are not irrelevant. One is relevant, another is irrelevant. So this statement will be what? Totally incorrect. So the right answer will be only statement 1 is correct. Let's move to second question. Which of the following is not the assumption of Walter approach to dividend valuation? Return on investment R and cost of equity K are constant. The firm has perpetual life. External financing is encouraged and investment programs are financed both by debt and retained earning, and option number D is none of the above. So basically if you see what is has been asked, not the assumption from or related to what? Walter approach to dividend. So first one is will be not there. R and K are constant, then firm has perpetual life, this is also correct. None of the above, this not, because the right answer is option number C. External financing is not encouraged, and not word is not mentioned here, so that's why this statement got encouraged. They say this model is based on internal financing through retained earnings only. Okay, but here debt and retained earning as mentioned, the statement got incorrect. Option number C is the right answer. External financing is encouraged and investment programs are not financed both by debt and retained earning. This statement is totally incorrect. Now let's move to next question. Which of the following statement concerning the payback period is incorrect? Capital betting techniques. The payback period is basically simple to calculate and understand. Then the payback period measures the time that the project will take to generate enough cash flows to cover the initial investment. The payback period ignores the cash flows after the payback point has been reached, and it takes into account the time value of money. Basically, the capital budgeting techniques are classified into the traditional and modern techniques, or you can say discounted or non-discounted techniques. So basically here the payback period, you have to tell what statements are incorrect. So basically, first of all, the payback period is what is simple to calculate. Yes, payback period is related to what, कि भाई तुम्हारा पैसा कितने दिन में वापस आएगा. So this is related payback period is simple. It's simple. So option number C1 will not be right answer. B, if you check, payback period measures the time that the project will take to generate enough cash flows to cover the initial investment. Basically, the payback period is determined in years. Okay, payback period ignores the cash flows after the payback period flows have been reached. Means, suppose you have invested 1 lakh rupees and in 5 years by the cash flow of 20,000 per year, you received your money back. Then you will, whatever money will come in the 6th year, you will ignore them. So this statement is also correct. So 1, 2 and 3 will be neglected. Option number D is the right answer, because the time value does not, money is not considered in the payback period method, because the payback period is non-discounted technique or traditional technique. Option number D is the right answer. Let's move to question number 4. The following is which one of the following methods is discounted cash flow technique? Payback period, average rate of return, discount to sales ratio, and net present value. So has been asked, which of the method is discounted cash flow? Discounted is totally where the present value factor is written. In other words, you can say it is asking about the modern technique. Payback is traditional, then average rate of return, it is also traditional. Discount to sales ratio is not any method in the payback period. The right answer will be option number D, net present value. Let's move to next question. Process of financial planning ends with preparation of the project statements, then preparation of the actual statements, then comparison of actual with projected, and ordering the employees that project figures on the same come true. So first of all, here the process of financial planning ends with, so first of all, what you will do, you will project the projected statement will be prepared, then actual statement will be prepared. So this both will not be the answer. Then you will order the employees that the projected figures whether they are coming or not. You will check this. Then you will, at last you will come the actual and projected, the comparison will be done. So option number C will be the right answer. The ending of the financial planning will be end with an comparison, or in another words you can say evaluation. Next question, statement 1. Sunk cost principle is followed under the capital budgeting and capital structure, and another statement is, during the capital budgeting process, valuation of project cannot be neglected. Evaluation of project cannot be neglected. Both statements are incorrect, both statements are correct. Only statement 1 is correct, only statement 2 is correct. So basically, statement 1 says sunk cost principle. Sunk cost principle is not the money which you have spent once on a project cannot be recovered. Okay, the cost which is you are not able to recover, that cost is called as sunk cost. It is followed under both capital budgeting and capital structure. This is followed under capital budgeting only, not in case of capital structure. Okay, so basically this statement got incorrect. If you see the second statement, capital budgeting process calculation, valuation of project cannot be neglected. So first, suppose you have A project, B project and C project. Before investing your money, because why, capital budgeting is related to long-term investment decision. So first of all, you have to invest the money. In which project you should invest, you will have to properly do the evaluation by using the capital budgeting technique. So this statement is correct, but this statement is incorrect. So your right answer will be option number D. Only statement 2 is correct. This is an error bug. So option number D, let me give a second. Option number D will be the right answer for this question, not this B. Only statement 2 is correct, 1 is false. Why? Because capital structure is mentioned in this statement. Let's move to another statement based question. Present value factors are used in computing both the discounted payback period and average rate of return. Statement 2 says, while calculating the average rate of return, the time value of money is taken into consideration. This is not average, this is average. Okay, let's see what the statement, you have the options, both statements are incorrect, both statements are correct, only statement 1 is correct, only statement 2 is correct. Now let's see what the statements. Present value factors are also called as overall cost of capital in the capital betting. The present value factors are generally used in the both in discounted payback period. In the discounting method it is used, but what it is said, discounted payback period it will be used but will not be used in the average rate of return. Why? Because average rate of return is a non-discounted technique, it is a traditional technique. In case of traditional technique, TVM is not considered. TVM stands for time value of money. So in case of discounted payback period it will be used, but in case of average rate of return it will not be used. So this statement got totally incorrect. If you check the statement 2, while calculating the average rate of return, time value of money is taken into consideration. This statement is also incorrect. Why? Because the because TVM is a average rate of return is a traditional concept, traditional technique. In case of traditional techniques, the time value of money is not taken into consideration. Okay, but it has said that time value of money is taken into consideration. That's why the statement got incorrect. Option number, the right answer for this question is option number A will be the right answer. Both statements are totally incorrect. Why? Because present value factor here due to average rate of return, and another the reason being the time value of money in case of average rate return. This has made the statements incorrect. Okay, option number A is the right answer. Now let's see which of the following is not applied in the capital betting. So cash flows calculated in investment is in incremental terms. Then all cost and benefits are measured on cash basis. All accrued cost and revenues incorporated, and all benefits are measured on the after tax basis. So basically not applied in capital betting, you have to say cash flows are calculated on incremental basis. So this is totally correct. All cost and benefits are measured on cash basis. This is also correct because we use generally the cash flow term. Then all benefits are measured on the after tax basis. This is also correct, but all accrued cost and revenues are incorporated. This statement is totally incorrect. So you have to say which one is not applied. So option number C, all accrued cost and revenues will not be incorporated. So the right answer in this question is option number C. Let's move to next question. Profitability index when applied to divisible projects impliedly assume that the project cannot be taken in parts. Then NPV is linearly proportionate to part of the project taken up. NPV is additive in nature, and both B and C. Basically profitability index is also called as benefit cost ratio. So it is when applied to divisible projects, it implies it assumes that the project cannot be taken into parts. It is project, investing in a project is one time investment only. You cannot break the project and do your investment again and again. So option number A will not be there. So NPV linearly proportionate to part of the projects taken up, and NPV is additive in nature. So the both statement is option B and C are totally correct. Okay, so option number D will be the right answer, B and C. Now let's move to next question. Which of the following is not a capital budgeting decision? Expansion of program, merger, replacement of an asset, and inventory level. So if you are expanding your business, if you are expansion program, so this is a capital budgeting. If two companies are getting merged together, this is also a capital budgeting technique, because large amount of money will be invested and large amount will be investment large sort of investment will be there. Replacement of assets. So suppose you have a land, but you want to replace your land or machinery. So this will also need large amount of money. So this 3 will be part of the capital betting technique, but inventory level is not associated with the capital betting technique. So option number D, inventory level, is the right answer. Which of the following is not true with reference to capital betting? So capital betting is related to asset replacement decisions. Cost of capital is equal to the minimum required return. Then existing investment in a project is not treated as a sunk cost, and timing of cash flows is relevant. Now let's see, capital betting is related to capital replacement decisions. So this statement is totally true. You have to tell what? You have to tell not true. Cost of capital is equal to minimum required rate of return. So this is also correct. So this will not be the answer. Existing investment in project is not treated as sunk cost. I have tell in the one of the previous question, it is treated as sunk cost. So this statement will be the right answer. And the timing of cash flow is relevant. So this statement will be also be not applicable. Option number C, existing investment in a project is not treated as sunk cost, will be the right answer. In capital betting, the term capital rationing implies means that no retained earnings available, that limited funds are available in investment, that no external funds can be raised, and that no fresh investment is required in the current year. So if you know about the term capital rationing, it is related with the limited funds. The company is having limited funds which it can use for investment. Okay, if a company want to invest in a project, in case the company has a limited funds, then the term used in this case is capital rationing. Okay, option number B will be the right answer. Which of the following is a risk factor in capital betting? Industry specific risk factor, competition risk factor, project specific risk factor, and all of the above. Okay, capital betting is a long term investment decision, so which is associated with the large type of project. So industrial factors risk factor can be there. Competition based, if two companies are competing and one company wants to take any capital betting decision, they will have to see what the competitors are doing. So this is also applicable. Project risk, investing in a project is associated with risk. So this will also be there. So obviously our right answer will be your favorite option, option number D. All of the above will be the right answer. Next question, the corporate dividend model is given by dash: John Linter, James E. Walter, William Denning, and Ezra Solomon. So first we have to do what? First we have to see who has given which model. Corporate dividend model is also known as Lintner model. Okay, Lintner, I told you the name. So obviously it is given by John Linter. Okay, James E. Walter has given the share valuation and Walter model. Then William Denning, he is totally out of question because he has no role in the financial management. Ezra Solomon has contributed in the capital structure approaches or theories, you can say, and residual approach to dividend he has also given. Okay, so this model of dividend is also given, the corporate dividend model is given by John Lintner. This model has focused on two different things. That first is the target payout ratio, and another target payout ratio means whatever you dividend want to pay to dividend in the long term perspective, in the long term period, whatever, by which rate. Suppose this is 10%, by 10% I want to give to my shareholders a dividend till next 5 years. So I will do. Now if I want to increase this 10% to 15%, what will be my speed of converting this 10% into 15% rate of dividend? It is indirectly concerned with the earnings. Okay, so option number A, John Lintner, will be right answer. Next question, according to the dividend irrelevance theory proposed by Modigliani and Miller, what is the impact of the dividend policy on a company's valuation? Option A, dividend policy significantly impact on the company's valuation. Then dividend policy has no effect on the company's valuation. Dividend policy only affects the company's short term valuation. Dividend policy is the most important factor on determining the company's valuation. So basically in case of dividend we have two types of theories. One is the relevancy theories and another is the irrelevancy theory. Relevancy theory consists of the Walter and Gordon model, and irrelevancy theory consists of the Modigliani and Miller. And another model which is concerned with the dividend is the Graham and Dodd model. Okay, let it be. So basically the most important factor, dividend irrelevancy means what? Whether you are paying dividend or not dividend will not have any impact on the value of the firm. So okay, this has been said by the Modigliani and Miller theory. Okay, then most important factor, you can delete it. Affect the company's short term valuation, this you can also delete it. And significant impact on the company's valuation, this you can also remove. The right answer will be option number B. Dividend policy has no impact on the company's valuation. Then what will impact the value of the firm? Company valuation will be affected by the investment policy, not the dividend policy. Okay, so option number B, dividend policy has no effect on the company's valuation, will be the right answer. Let's move to question number third. Which of the following is a limitation of the Gordon growth model? It can only be applied to the companies that do not pay dividend. Then it does not take into account the risk of investment. Then it assumes the growth rate is higher than the cost of equity, and it assumes that the dividends grow at a constant rate forever. Then try to understand this question. It is asking about the limitations of Gordon model. Okay, so first of all, wherever it has mentioned only, it can be only applied to companies that do not pay dividend. It is not paying dividend, then how you can apply the Gordon growth model there? So it is not possible. No? It does not take into account the risk of the investment, so this is not considered. Risk is considered. Okay, now third one is it assumes that the growth rate is higher than the cost of equity. This is not a limitation. Now if you check the last option, it assumes that dividend grow at a constant rate forever. Due to this, the biggest limitation of the Gordon model is it assumes that the dividend grow at a constant rate forever. This is only the major limitation of the Gordon growth model. So option number D will be the right answer. Let's see the next question. According to Walter model, if the internal rate of return R is greater than the cost of equity K, the firm should. Yesterday I had told you the major conditions regarding this, so hope you will do it correctly. So pay out all the earnings as dividend, retain all the earnings for reinvestment, follow a residual dividend policy, or borrow more funds to pay dividend. Okay, so this will no borrowing will be done, no residual policy will be followed. Either now it is saying what R is greater than K. Okay, returns are greater than cost of equity. So in this case we will retain the earnings for reinvestment purpose. Okay, we will retain the earnings for the reinvestment purpose. So option number B will be the right answer. If it has asked R is less than K, R is less than, at that time the company will pay out all the earnings as a dividend. So option number B, retain all earnings for reinvestment, is the right answer. Let's move to next question. Which of the following argues that the value of the levered firm is higher than that of the unlevered firm? Net income approach, net operating income approach, then model with taxes, and both A and C. Now if you say what it is asking, then what it is asking, okay, sorry, there was some this one error in this question. The option number C is the Gordon model. Okay, option C is Gordon approach. So if you see that which it is asking about the levered firm. Levered firm means what? The company who has taken debt or who is using debt. So it is also called as a levered firm. It can be it will be higher. The value of the levered firm means the company who is who is using debt will have a greater value as compared to the company who is not using debt. So this is basically said in the net income approach. Okay, net income approach says what? Net income says that whenever you grow the value of the firm, whenever the use greater amount of greater amount of debt in your capital structure, the value of firm will rise and the overall cost of capital start reducing. Okay, so option number A, net income approach, will be the right answer. Next question, the cost of equity share capital is greater than the cost of debt because equity share carry higher risk than debt. The face value of equity shares is lower than the face value of debentures in the most cases. Then equity share do not provide a fixed dividend rate and equity shares are not easily sellable. Now let's see what is the reason behind that the equity cost, that the cost of equity is greater than the cost of debt. Now first of all, try to eliminate one by one. Equity shares are not easily sellable. This is not an appropriate answer because sometimes people want to be owner of the company. They purchase equity shares so that they should get voting rights. So these are sellable. So this option does not exist. Equity share does not provide a need of dividend, fixed dividend rate. This is true, but it is not, it doesn't mean that equity share cost of equity should be high. So this is also inappropriate. Then the face value of equity share is lower than the face value of debentures. So this option is also incorrect. The right option is equity shares carry a higher risk than debt. That's the only reason that the cost of equity is high. If you haven't studied the NOI, means the net operating income, it states that after raising the amount of debt raising of debt into after beyond a certain proportion, the cost of equity starts rising because the equity shareholders feel it more risky. That's the reason that equity share is involves the cost of equity is greater than the cost of debt. Option number A, equity shares carry a higher risk than debt, is the right answer. Next question, Gordon model of dividend relevance is same as no growth model of equity valuation, constant growth model of equity valuation, price earning ratio and inverse of price earning ratio. So price earning ratio, it is not the Gordon model is, Gordon has given in the computation of cost of equity, Gordon has given a DP plus growth model, dividend price plus growth model he has given. So the Gordon model of dividend is relevance in same as the option number B is correct answer, that is constant growth model of equity valuation. Option number B will be the right answer. Next, see, the term capital structure denotes total of liability side of the balance sheet, equity funds, preference capital and long term debt, then total shareholders equity and types of capital issued by the company. Types of capital, company can issue both the types, short term and long term. So basically what the types of capital the company is issuing does not matter here. Then types of shareholder total shareholder equity, this also is not applicable in this question. Capital structure it is talking about. So capital structure, long term sources of finances will only be considered. Then liability side of balance sheet, in case of liability side there are both current as well as fixed long term as well as short term liability. Short term liability will not be considered. So the most accurate answer here is equity funds, preference capital and long term debt. Okay, this play a major role in the computation of capital structure of the company. Now let's move to the next question. Here you have a numerical practical based question. Cameron Industries is expected to pay an annual dividend of rupees 1.30 a share next month and the market price of the stock is 24.80 and the growth rate is 3%. What is the firm's cost of equity? So it has asked to compute the cost of equity. So to compute the cost of equity, here what are the things given to you? One is the growth rate, another is the market price of stock, and the most important thing is 1.30, that is the expected dividend. Okay, so 1.30 upon the 24 by 0.80 we will write here, and plus the 3%, whatever the 3% is mentioned here, you should mention it 0.03. Okay, after solving the this is the formula for computation is d1 upon P0 plus G. Okay, this is the formula of the growth model. Now after solving this numerical, you will get the answer, that is the 8.24%. okay, after solving this numerical, you will get the answer 8.24%. okay, for if you want me to solve this, after solving this numerical first portion, when you will solve the first question, you will get the answer, that is the 0.0524. then you have to add 0.03 in it, and then you will get 0.0824. when you will multiply it by 100, you will get the answer 8.24. One second, you will get the answer 8.24%. so option number C will be the right answer. okay, option number it is not mentioned here. Option C will be the right answer, 8.24%. Next question, the selection of the one proposal based on the choice of other proposal is called contingent investment proposal? No. Replacement proposal means, suppose you have project A and you have project B also, so you have to select selection of project A. Will you replace by B? No. So this is selection of A will not be replaced by B. So replacement proposal also an incorrect option. Independent investment proposal means selection of one has no impact on the another. So this will also not be not correct. The right answer here, the most accurate one, is the mutually exclusive proposal. And which method of capital budgeting is most appropriate for the mutually exclusive projects is the NPV, that is the net present value method is most accurate. okay, mutually exclusive projects is what? Mutually exclusive means what? One, if you suppose A and B are two projects, and you want to select A by application of proper capital budgeting techniques, you decided to select the project A. When you will select A, the project B will automatically get rejected. okay, this is the concept behind the mutually exclusive project. okay, so option number D is the right answer. Mutually exclusive proposal is the right answer. Suppose, for example, I will let me give you another example. Suppose you want to marry and you are looking for various brides. Whenever and you got 2-3 proposals, one of them you have selected, another two are automatically rejected. okay, so let's this was just a joke, ignore it. The DCF technique of capital budgeting does not include the following. Now DCF is what? DCF is the discounting factor technique. okay, net present value, PI profitability index, IRR internal rate of return, and ARR average rate of return. okay, NPV method, this is discounted. Then PI method, this is also discounted. Present value factor is used in this case. In case of internal rate of return, here also present value factor is utilized. But in case of ARR method is the technique which is traditional in nature, and here it does not consider time value of money. So DCF is not used in it. So, okay, so option number D, ARR average rate of return, will be the right answer. Next concept, here also we have a practical on cost of capital. A company issued limited rupees 100 lakh 14% debenture of rupees 100 each. Tax rate is 40%. You have to calculate the cost of debt with a 10% premium and 5% of flotation cost. So this is cost of debt, you should know. Generally there is a chance NTA can ask you questions from the cost of capital. Numerical based question will be asked. So first of all, try to understand the formula. Cost of debt is equal to interest upon net proceed 1 minus tax rate into 100. Okay, now let's see, now put the values. The 14% debenture is what? It is the interest rate. Okay, 14% is debenture is what? It is the interest rate. Then we what else we have given? 40% tax. 40% this will be written as 0.4. Okay, now you will ask, sir, what to do with the net proceed? From where we will bring the net proceed? Don't worry. I will tell you how you can bring the net proceed. First of all, you have given what? You have given the 100 as a face value, and what it has said that the company is issuing the share at the premium, the debt is issued at 10% premium. So first of all you have to add the 10 and 5% flotation cost. You will subtract the 5% 5. So this 105 whatever you get after doing this, after solving this equation, so this 105 is what? This 105 is your net proceed. So whenever you solve this, after solving this you get 0.14 into 0.6 by 105 into 100. So the right answer which you will get is that is 8%. 8% is not not mentioned here, but an approximate answer, that is 8.03 is mentioned here. So your option A will be right, that is option number A, 8.03%. okay. So I hope you have got the question. If you haven't got, you can take the screenshot of this slide. Everything is mentioned here properly. Now let's see the another one. Ram Limited Company issued the rupees 100 lakh 12% debenture of 100 each. Tax rate is 50%. Calculate the cost of debt with 5% discount and 3% flotation cost. Now while compute now everything will be same, but let me help you to solve it. First of all, interest upon net proceed 1 minus tax multiplied by 100. okay, so let's put the values. Means here the interest is 12%, then what else we have given? The tax rate 0.5 we will write here. Then after mentioning here, after solving it, we will get 50 net proceed. Net proceed we are yet to compute. okay, just a second. okay, KD interest upon net proceed 1 minus tax multiplied by 100. दिखेगा नहीं इनको. Let me write here. Interest upon net proceed 1 minus tax multiplied by 100. This is the formula. Now start putting the values whatever is available. So 12 is available, then 1 minus 0.5 is available, and into 100 is available. We are yet to compute the NP. Now in case of premium, whenever the debentures are issued at premium, first of all you should add the value. Whenever the debenture is issued at discount, you should reduce the value. If the dividend are issued at par, you don't need to do anything, keep it as it is. So the face value of the dividend is 100, the rate of discount is what? 5, and the flotation cost is 3. okay, so you will get, after reducing 8 from 100, you will get 92. This 92 is what? This 92 is your net proceeds. okay, this 92 is what? Net proceeds. After solving this equation, you will get the answers 6.52%. okay, 6.52% is the right answer. I am not providing the calculation because I know that you are well enough in it. okay, mastery, you have well mastery in it. So I have shown just how to calculate the net proceed and how you can put the do the calculation. So option number C will be the right answer. This question the solution has been provided here also, you can solve it. Now let's see, a company has a preferred stock pays the annual dividend of rupees 6 and is currently priced at rupees 50. What is the cost of preference stock? 8%, 9%, 10%, 11%. So basically it has said that preference stock annual dividend of 5 is being paid and the currently 5 at 50. okay, this is what the preference KP is not, this is not Kadi Pakoda, this is D1 upon P0. P0 it is the expected rate of dividend and this is the current price. So this is 5 by 50, this will be nothing but 1 by 10, but it is the simplest is 10%. okay, option number C, 10% will be the right answer. Next, let's see the next question. A firm's common stock is currently, common stock means what? It is talking about nothing but the equity share. Okay, now equity share, it is selling about the 40 per share. Okay, currently selling price is what? Same formula you have to use, but here it is mentioned what? Constant growth rate at 5%. Constant growth rate. So immediate, no need to worry. You have to put the formula, that is D1 by P0 plus G. Okay, now let what we have to do, first we have to check the values, where are they. So selling for 40 rupees. Okay, then 2 by 40, and then the expected dividend is 2, and the growth rate is what? Growth rate is 5%. So you add 0.05 here. So by solving this numerical, you will get the value 10%. Okay, you will get the value. This will be 1 by 20 and 5% plus 5%, you will get 10% here as an answer. Okay, this will be your answer, but 10% is not mentioned accurately, so you should not worry what to do, sir. So this 10.2 will be your answer. Okay, option number B, 10.2% will be your right answer. Okay, so this numerical has been solved for your convenience, you can check it. So that's all for today's session. I hope you enjoyed the session. So thank you, bye, good night. I hope you enjoyed the session. If you like the session, just hit the like button. Your one like motivates us. Let's see you in next video. Thank you, bye, good night.